Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for 𝗧𝗴𝗃. Today is Friday. It is the 3rd of September. I don't know where the summer has gone. I honestly do not know where this summer has gone, but I do know that it was my daughter's birthday yesterday, and we had a great time celebrating. So it's the 3rd of September. It is a Friday, and we've got employment data. We've got a big report on the docket. It's coming out in about an hour and 6 minutes or so. I wanted to give it to you nice and early today. The expectation is 740,000 and unemployment rate of 5.2%. Remember that number, all right? Remember that number. Very important. And again, if the number is lower, all right, it's not going to be a great thing. If the number is higher, it's going to be better. So again, it's one of those situations where keep your eye on the number and just pay attention to the consensus. When the consensus is this wide, 377 to 900,000, 5.1 to 5.7, it actually gives me a good idea that the government does not know or have a good feel for the actual number that's coming out. But again, consensus is about 740,000, unemployment rate 5.2%. Honestly, between us, I'm more focused on the unemployment rate. I want to see the unemployment rate go down. I think these numbers are still very skewed, but I think the unemployment rate is actually on the dot. So I'm looking more at the unemployment rate. If the unemployment rate drops to 5.1%, 5%, that means the bond market, and I want to explain to you the relationship. That means the economy is running hot. If the economy is running hot, the bond market will drop. It's already a little bit lower. If the unemployment number is 5.5, 5.7%, then the odds are the bond will stay where it is, or alternatively, go a little bit higher. I don't think there's that much more upside to the bond market because the Fed is not going to lower rates. The best case scenario is they'll just maintain the status quo, but they're not going to lower rates. So remember, bonds, interest rates, opposite of each other. I talk about it all the time. So that's the big report. That's what everybody's looking for. And the number is 740,000 or 5.2%. And again, I'm more focused on the unemployment rate. Sectors to watch today. Consumer discretionary. Keep your eye on the sector. It's breaking out. If consumer discretionary can break out, there's a good chance, because consumer discretionary has a lot of retail, and retail makes up 2/3 of the GDP. So there's a lot of instrumental value that's much deeper than just the consumer discretionary sector. This will give us a good idea if economy is expanding, and I think if the economy is expanding, we're going to see a breakout on the consumer discretionary, but don't hold your breath. It's probably not going to happen till well into next week, because again, nothing really picks up before the Labor Day holiday is over, and then it takes another week for the traders and investors and hedge funds to get back on track. So keep your eye on consumer discretionary, and another sector you want to keep your eye on is the financial sector. I think the financial sector is going to try to make another higher high, because I think the interest rate pressure is going to be on them, or on the Fed, and I think the financial sector, which benefits from higher rates, is going to continue assimilating that in its price like it's been doing for a while, and I think this trend will continue. We've seen pretty bullish bias. We have a nice little flat top, highest price in 3 months. There's a really good chance we're going to break out higher from these levels, especially due to the calm nature and the fact that financials are defensive. So financial and consumer discretionary are the two sectors that I'm looking at. Now, looking at the broad market, you're not going to learn anything new here if you watch my videos every day, because this is craziness. We made all-time highs. RSI could barely go to 70. Again, if you go back here, RSI here was at 80, and we were at 416. Now we're at 454, and the RSI is 71. This is telling us that the market is so stretched out, so overbought, that it just can't, it has no elasticity in it. And that's not a bullish sign. Now, I know I talked about consumer discretionary and I talked about financial sector. Now, financial sector can still break out higher if the market goes lower. Consumer discretionary, I don't think so. And I honestly think we're going to pull back. So I'm not as optimistic that we're going to see consumer discretionary break out as a lot of traders are. But again, I need you to pay attention. because we haven't broken out yet. And the level, the breakout level is not technology. I don't even know why I'm doing this. It's early in the morning, consumer discretionary. Here we go. Again, keep your eye on the 185, 186 level. I think 186, 187, the higher we get up here, the better it'll be for market sentiment. Consumer discretionary is driving sentiment right now, but I am liking it, but I don't think we're ready for the breakout just yet. I think we're going to go down before going up because we are seeing this massive divergence built up. And even if institutional funds come in, they realize the market's a little overbought and it may be time to go back to the 50-day moving average or even a little bit lower. So don't be surprised if we go lower before going higher. And there's more evidence of that. I'm Sherlock Holmes. No, I'm just kidding. Evidence of that. This is the, why does it do this? Let me clear all the tools. There we go. Let me clear now all the studies. There we go. So you could see here, this is the put to call ratio. Let me make it a little smaller here. Here we go. So it's a little smaller. And as I always tell you, this thing is pretty random unless we go above 1 or we go below 70. And it looks to me like we're slightly below 70. Now, I've been talking about this, and I've been talking about how it's been going oversold, overbought, oversold, overbought, back and forth over a period of a few days. That's because the market is extremely choppy. If you look at the mid caps, for example, right, take a look at how choppy they've been. Here, let me show you. Very, very choppy. I mean, look at this trading action. Chop. That's really what the overall market looks like. The S&P doesn't look like this because you have that overcapitalization with large caps. But if you strip away, if you see this, look at that. Look at the trend, right? Going higher, probably at about a 20-degree slope. Now look at the equal weighted SPY. Not nearly as much, right? A lot lower slope. This is what happens when you strip away all the market cap from the SPY. Still trending, but not at that slope that we saw a second ago. I'll go back. You could see the slope. Look at that. Much greater slope. So there's a lot less smaller stocks making 52-week highs than large cap stocks. And the put to call ratio is back below 70. That means the market is getting a little too exuberant and we need a pullback. And considering the fact that if you look at momentum levels, I'm going to show you momentum levels. There's only 58% of stocks trading above the 50-day moving average and only 59% of stocks trading above the 200-day moving average. And when you look at the 200-day moving average on a long-term basis, you will see that it's been coming off, little by little coming off, and I think it's going to continue coming down. Let me see if I could get rid of these studies. There we go. See, it peaked out, and every time it peaks out, it comes down. It takes time, but it comes down, and I think we're going to come down. So I'm looking at that put-to-call ratio, and it's telling me, and remember, all of this is randomness. It only matters when it goes above 70 or below, above 1 or below 70, and it's below 70 right now. Now, in light of that, we've got a put-to-call ratio that's overbought. We got divergence in the stock market. We got fragmentation in the major sectors, as I'll show you right now. Look at technology, look at consumer discretionary. Big fragmentation. They should be next to each other. That's telling us the market is fragmented, and there's a good chance with this put-to-call ratio, we're actually going to go lower before going higher. And therefore, I've got some short stocks for you. Look at this. SunPower. Breaking below the 200-day moving average, 50-day trading below the 200-day moving average, swing low, moving up to the 20-day EMA. There's a good chance it's going to come down. SunPower. Downside. Next one, Trinseo. Again, made an all-time high or a swing high long time ago, been going down below the 200-day moving average, 50-day below the 200-day moving average, pulling back to the 50-day line, even above the EMA now. I like this one right where we're at, With this one, you may want to wait just a little bit more for it to go a little higher, but with TSC, we're ready to go to the downside. And I think this can go down all the way to 43. That's a good $9 in there. Next one, 𝗧𝗴𝗀 New Energy. 𝗧𝗴𝗀. Again, below the 200-day moving average, 50-day below the 200-day moving average, all the way up to the 200-day moving average. I think it'll go back down from the 60-ish all the way to the 40-ish level. So I like this continuation. Last but not least, Q2 holding below the 200-day moving average, 50-day below the 200-day moving average, moving up to the 50-day moving average on a swing low pullback to the downside. You will notice all of these have something in common. They're all trading below the 200-day moving average. The 50-day is trading below the 200-day moving average as well. The 50-day, the blue line crossed down from the mustard colored line, and there's a pullback to the upside. Pull back to the upside, 50-day below the 200. Pull back to the upside, 50-day below 200. Pulled back to the upside, 50-day below 200. And pull to the upside, 50-day below 200. Now, before you guys go, I've got something really, really important for you and timely. Folks, there's a massive discovery that can help everyday traders grab triple-digit windfalls from the markets from a simple 0.01 rating formula. And Wall Street expert Chuck Hughes, he's been able to use this formula to signal a recent 96.2% win rate on over 100 positions. The stock market has been filled with market-moving catalysts. Folks, market-moving catalysts. They've been all over the place. I mean, put the call ratio, divergence, don't get me started, the Fed. And it's gotten harder to pick winners as a result. Imagine having a strategy like this to help you navigate all of the data on Wall Street today. Now, for the first time ever, Chuck is sharing it with the world. Click on the link below to learn about the 0.01 rating and Chuck's Omega-1 strategy. Do it now. And as always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market. Be the first to be notified when I post my next video. Bye.